Greetings. In this video, we're going to take a look at the post-COVID 2020 to 2023. I have data through 2022, but I have a little bit of data into 2023. But we're looking at the post-COVID period for monetary policy. And what we're going to see is a very, very interesting phenomenon. We're going to see what I call contradictory monetary policy. We're going to see a couple policies that seem to be working in opposition to each other. But really, at the end of the analysis, I think you're going to agree with me that these policies are actually complementary based on the goals that Congress has given the Fed to accomplish. So let's go ahead and dive right in and explain this. This is going to be a rather sophisticated presentation because I'm pulling a lot of things together in this particular video. So don't be surprised if you have to watch this video twice. Certainly watch the video and go read the material in the e-workbook. And I strongly encourage you to take notes. You need to not just look at this, but you need to write it down, play with it, and begin to internalize this information. If we look at the Fed's balance sheet, between 2020 and 2022, we see again that the Fed is back to increasing the size of its assets, that it has been very, very busy after COVID in terms of purchasing government bonds and mortgage-backed securities. So we see that its assets increase about 33% in 2 years. Another dramatic increase in the Fed's assets. And the Fed's now holding in the neighborhood of $8 trillion plus in assets, record levels of government debt being held by the Federal Reserve System. Now, why would the Fed do this? Well, this is expansionary monetary policy. And even though we're now in a period of inflation and the economy seems to be growing again, the Fed wants to do something that's expansionary. So when the Fed buys government bonds, what does that do? It drives up government bond prices. It drives down government bond yields. And it makes it cheaper for the federal government to borrow. It makes it cheaper for the federal government to borrow when the Fed is buying government bonds. It also pumps a lot of reserves into the banking system and makes banks a lot more comfortable because there's a lot of reserves in the banking system. Now, here's the gist of this. Here's the real reason for the Fed's expansionary stance at this point. The Fed is trying to accommodate federal government spending. Post-COVID, the federal government, during COVID and post-COVID, the federal government has really been pouring it on in terms of government spending. So government spending, the size of the federal government's budget has increased dramatically because of COVID and the after effects of COVID. From buying and financing medical procedures and medical, vaccines and things like that to help curb the virus itself, to giving money to businesses to help businesses stay afloat, to giving money to consumers to giving money to citizens who've been laid off, who need to buy things as consumers, and on it goes. The federal government has really opened up its coffers and been pouring out funds. Now, keep in mind that the federal government and the Fed are two completely different entities. Federal government is the executive branch, the legislative branch, and the judicial branch, as outlined in the Constitution. And the executive branch, of course, is headed by the president, and the president and the Congress work these things out according to the constitutional framework. And the government spends funds on things, all sorts of things. But it has to finance that spending. On the other hand, the Fed is an independent central bank created by the Congress influenced some by the president in that the president gets to appoint its leaders, but this bank is supposed to be a relatively independent central bank, not beholden to Congress, not beholden to the president, not beholden to anyone except hopefully the wisdom of wise and sound monetary policy. Okay, those are high ideals. We hope they reach them. So why is the Fed buying bonds? To accommodate the federal government's spending. How does it do that? Why is it doing that? Well, let's drill down a little bit. When the government spends, it doesn't want to raise taxes to pay for that spending because raising taxes is contractionary. All right, cutting people's taxes causes them to spend more. Raising their taxes tends to cause them to cut less. So it doesn't help the government to spend more and to pay for that with higher taxes. All you're going to be doing is transferring private spending into the hands of government and making that public spending. So what the government will like to do is borrow. This is called deficit spending. And households know all about this. When you don't have enough funds to buy what you buy, you use a credit card. That's called deficit spending, borrowing to spend. When I don't have the income to spend, borrow. The federal government does the very same thing. In fact, every year the federal government borrows to spend and runs up this very high national debt as it does so. So the whole purpose of this is expansionary fiscal policy. You go, well, what's expansionary fiscal policy? It's doing something, in this case, increasing government spending to try to boost GDP, and this is after COVID. So really, the government is trying to boost the economy, keep the economy strong, keep the economy growing, and it's borrowing and spending to do this. The problem is, when it borrows a lot, it raises interest rates. Think about this. When the federal government borrows, it sells bonds, it supplies the bond market with more bonds, the price of bonds drop, and the yield on bonds have to increase. So to sell those additional bonds, it has to raise bond yields. That means it's got to pay more for the debt that it's issuing. But the Fed can help out with this problem. You go, how? By accommodating, by buying government bonds as the federal government is selling more government bonds. Think about this. Federal government is selling more government bonds to finance its spending. If the Fed steps in and accommodates the federal government by buying more of these bonds, guess what? Well, you know the story. Fed buys bonds, increases the demand for these bonds, drives the price of these bonds back up, drives the yield on these bonds back down. So when the government is selling bonds, bond prices are dropping, bond yields are increasing. It means debt is getting more expensive to finance. Fed steps in and accommodates. How? By buying bonds, more bonds. Demand for bonds increases, bond prices increase, yields drop. This is called expansionary monetary policy. You'll see that right down here. Now, this is all review. You've seen this. You've seen this before. But now we're linking it to the federal government. So the federal government is engaging in expansionary fiscal policy, and the Fed is accommodating that expansionary policy that the federal government is doing by engaging in expansionary monetary policy. So expansionary fiscal policy and expansionary monetary policy walking hand in hand down the path of trying to get the economy going again. Now, you say, but this doesn't sound like an independent central bank. Well, I will tell you, there's a lot of complaints about this when the Fed does it. Fed did it way back in World War II. Talk about this in the e-workbook. I don't want to tell the whole story. You'll read about it. But I'll give you a quick course in it. We financed World War II largely with borrowed funds. We sold war bonds. So we're fighting a war in Europe and we're fighting a war in Asia. And our federal government hadn't prepared for that, hadn't put away money. Governments don't put away money for wars. When they happen, They're emergencies, and it's like a credit card. If your car breaks down, if your house burns down, you're going to borrow. You don't have funds generally set aside to replace your car if it's wrecked. Now, hopefully, you have insurance on it, but if something is lost, oftentimes if you have an unexpected expense, you often have to borrow. Many people have to borrow to accommodate that. So the federal government in World War II wasn't ready for World War II until it got into it. But once it got into it, it realized it couldn't finance it unless it borrowed. And it would borrow primarily from the American people by selling war bonds. But the selling of war bonds drives up, the more bonds you try to sell, the higher the interest rates you have to put on them to sell them, to get them to move. To sell war bonds, you have to put a good interest rate on them. To sell more war bonds, you have to put an even higher interest rate on them to get people to buy them. And yes, patriotism helps you buy a war bond, but you still have to be paid an interest rate, and it's got to be an interest rate that satisfies you. So the point is, the federal government was putting a lot of war bonds out there, and interest rates on these bonds were very high. FDR, Franklin Delano Roosevelt, the president at the time, basically twisted the arm of the chairperson of the Fed and said, hey, you need to help us out. You need to buy some of these bonds. You need to accommodate our sale of war bonds. And so basically the president got the Fed through just basically arm twisting, got the Fed to basically buy a boatload of these war bonds, and by buying these bonds, drive the price of these bonds up and drive the yield on these bonds down. So in other words, the Fed was competing with other bond buyers for these bonds, driving the price up, driving the yield down, and keeping the war effort financed with relatively inexpensive debt. And there was an accusation made against the Fed at that time and afterwards that basically FDR had the Fed in its pocket and that the Fed had lost its independence. And that's a legitimate argument. But in times of war, lots of things like that happen. These democratic ideals tend to get put aside during wars, and people think that FDR behaved more like a benevolent dictator during World War II than as a president in a democratic country. And different people will differ on that opinion, but clearly the Fed will step in during national emergencies and try to help out. And one way the Fed can help out is by accommodating expansionary fiscal policy up here with what we call expansionary monetary policy down here. Okay? You say, I'm confused. My head is spinning. This is a lot of stuff on one page. It is. So you can stop the video. You can take notes. You can think about this. If you have a question and you can't get an answer to it, either by rewatching the video or reading the material, guess what? You can send Mr. Sipsic a note, and Mr. Sipsic will give you a personal explanation again. These lower bond yields make it cheaper for the government to borrow and effectively keeps the size of the deficit down, or keeps it smaller than it would be, keeping the interest payments on the debt. Oftentimes the government is rolling the debt over. So the government is issuing new bonds to replace debt that has expired and to pay for the interest on the debt. Okay, so the debt gets rolled over. And so lower interest payments mean ultimately lower debt in the long run. Now, that's the expansionary side of the post-COVID policy, and we see that that's to accommodate government spending. But the Fed is also engaging in contractionary monetary policy at the same time. The Fed is raising the IOR rate, the interest on reserves rate. And by doing so, I talked about this a little bit a video or two back. Okay, I've been talking about it, that if the Fed raises the IOR rate, that will raise the federal funds rate, and then of course we know the rest of the story, raise the prime rate and other linked interest rates here. So a higher IOR rate leads to a higher federal funds rate. Now I'd like to explain that again because it's still a relatively new idea. The IOR is the interest rate on reserves. So now the Fed is permitted, Congress permits the Fed to actually pay interest on reserves, bank reserves. If a bank deposits funds with the Fed into one of these Fed accounts, it is paid interest on those reserves. Now, those accounts compete with the federal funds market. You go, what do you mean? Banks can loan to each other. Remember, that's called the federal funds market. So Bank A can loan to Bank B in this federal funds market, or Bank A can take its reserves and put it into an account with the Fed. Bank A is going to make that decision based on which pays better interest. So if the Fed raises the interest rate on reserves and the interest rate on reserves is higher than the federal funds rate, now think about this. What are banks going to do? The money is, the reserves are going to go into these accounts, and banks are going to be less likely to offer loans to other banks, right? That'll decrease the supply of funds being offered in the federal funds market, and the federal funds market will go up. Okay, so let me say that again. Okay, if the Fed raises the interest rate on reserves, banks are going to, above the federal funds rate, current federal funds rate, banks are going to find that putting funds in the Fed and getting this interest rate on reserves is a better option than loaning these funds to each other in the federal funds market. So what will happen? Funds will come out of the federal funds market and go into some of these bank accounts banks have with the Fed. But if there's a decrease in the supply of funds going into the federal funds market, then what will happen? The federal funds rate will increase. So this will equilibrate. And what we find is the federal funds rate will track the IOR. They will stay very, very close. Very, very close. Okay? If the federal funds rate is higher than the IOR, I'm going to do it in reverse now. If the IOR rate is dropped below the federal funds rate, then funds are going to move out of these accounts with the Fed, and they're going to move into the federal funds market, and the federal funds rate is going to drop and follow the IOR rate down. So as I said in an earlier video, the FFR, the federal funds rate, tends to follow the IOR. So this is what we would call an administrative rate, admin rate. It basically is set by the Fed, and then the Fed just lets market forces work, and this federal fund rate will chase it. Okay? And of course, the Fed can no longer move the federal funds rate with open market operations because we're in an ample reserves environment where movements in the supply curve have no effect on the federal funds rate. Now, if we go down to the 2023, I produced this graph in early 2023, so the data has already changed some. Actually, the discount rate is higher than this, and the federal funds rate is actually higher than 4.9 at the time I'm doing this video. But earlier in 2023, I produced this graph, and this was the data at the time, and you can see there's some changes. For one thing you see here is that the demand curve for reserves bottoms out not at 0, but bottoms out at 4.9%. And the reason for that is the IOR sets the lower limit on where the FFR can go. The FFR can't go below the IOR for the reasons I just explained. If the FFR went below the IOR, then banks would not want to lend money in the federal funds market. They'd want to lend it, just take it and put it in their account at the Fed and basically have the Fed pay them interest, effectively lend it to the Fed. So the FFR won't go below the IOR. So if the IOR rate is set at 4.9% by the Fed, it's administratively set, the FFR will have to be near that rate. And once you get past this downward sloping part of the demand curve, you're on this flat portion where are we hitting this horizontal level? It's at 4.9%. Interest rates won't drop below 4.9 because that's where the IOR is. Okay, notice also that the supply curve hits the demand curve again on this very flat portion. So this is a sign of what? Ample. Ample means there's a lot of it. If you have an ample amount of food in your cupboards, there's a lot of food in your cupboards. You've got enough to cover your needs and more. Ample means beyond what you need. So what this is saying is the supply of these reserves is so great that it's beyond what is needed to keep the interest rate, to influence the interest rate. There are so many reserves in the banking system, we can't manipulate the federal funds rate with this any longer. So if you look back to 2020 during COVID, this supply curve is way back here. It's way back here. But as I said, between 2020 and 2023, the Fed's balance sheet grew again. The assets grew, which means the Fed bought a lot more bonds. And as I explained just a few minutes ago, the purpose of that was to keep bond yields low. But it had no effect on the FFR. No effect. Okay, that'll have to be moved by something else. Okay. Notice the Fed's stance here has gotten more contractionary. Even though the Fed has pumped more reserves into the banking system to accommodate federal government spending, the Fed is saying something else with the IOR. The Fed has raised the IOR from 0 during COVID. Remember, during COVID in 2020, the FFR was way down here at 0. And the flat part of the demand curve was way down here. Remember, that demand curve sloped all the way down to 0 and then hit the flat portion down here. But the Fed has decided to raise interest rates. And I'm going to explain why they're doing that in just a minute. And how did they raise the FFR from 0 up to near 5%, up to 4.9% at the time this graph was developed? By raising the IOR. So by raising the IOR, what's happening? Funds are being sucked out of the federal funds market and is going into these Fed accounts, meaning there isn't many funds in the federal funds market, and that's driving up the federal funds rate. So the federal funds rate starts to chase the IOR up. Okay? And once it reaches where the IOR is, it doesn't go above it. Okay, it will equilibrate around the same level. Okay? Interesting stuff. And notice that the Fed keeps the discount rate above the IOR. The Fed doesn't really want people, banks, using the discount window unless it's an emergency. So the Fed prefers that the FFR, the federal funds rate, in the federal funds market be where banks borrow. They borrow from each other. And so either your option as a bank is either to go borrow in the federal funds market, or to loan in the federal funds market, or to park your funds in an account with the Fed. And the Fed only wants you coming to the discount window if you're in some sort of emergency, and it wants to charge you more for that money because you're riskier. Okay, so the Fed always keeps the discount rate above the IOR. And notice the demand curve, I explained this earlier in one of the earlier videos, the demand curve, the upper limit on the demand curve is the discount rate. If the federal funds rate were above the discount rate, people wouldn't borrow from other banks, people would borrow from the Fed. But the Fed doesn't want that. The Fed wants banks to borrow from each other first. And then if they get into some sort of emergency and can't borrow from another bank, they can come to the Federal Reserve discount window. Okay? So the discount rate is always going to be administered, kept above the IOR, which is where the federal funds rate will be. It's always the case. Okay? So that explains this diagram. So what we've seen then is really a contradictory policy to what I talked about earlier. The Fed's really been raising the IOR, and in the process has been pulling the FFR up. And again, this has nothing to do with the amount of reserves in the banking system. It has to do with how those reserves are used. Are they basically parked in a Federal Reserve account earning interest, or are they loaned out to other banks? That's the question. Okay? Those are the only two places you can park it. You can either park it in your own account or loan it out to another bank who will park it in its account. Okay? Now, what we know is if you raise the federal funds rate, you're raising what? You're raising interest rates, short-term interest rates. And that tends to be contractionary. That tends to dampen consumption and dampen investment. Why would the Fed be doing that? Because the Fed is concerned not about recession any longer. The Fed is more concerned about inflation. Prices have been increasing fairly dramatically after COVID. And some of that was due to the supply shock, the interruptions on the supply side, but some of it was due to restrictions on the supply side and that pumping up of demand that the federal government was doing during COVID. So prices have been rising after COVID, and there was pent-up demand. There were things people wanted to buy during COVID they couldn't buy, and there were things they wanted to do that they couldn't do that they're now doing and they're now buying. And they've got the income to do that. And so that's pushing prices higher. So the Fed is raising interest rates to try to curb some of that, trying to cool that a little bit by cooling consumption and cooling investment, and hopefully bringing the inflation rate back down. Near 2% is where we like it. We've seen inflation rates as high as 8% after COVID. That's way above what the Fed likes to see. The Fed likes to see inflation rates around 2%. Now, the risk of this is if the Fed goes too tight, if the policy is too tight, it could actually cause GDP to fall and unemployment to rise. So there's a risk to this. There's a risk to contractionary monetary policy. Raising interest rates can put the brakes on too hard and cause the economy to lurch into a recession. Okay? I hope this explanation helped you. It's complicated because you have two policy goals. The Fed wants to keep what? Output increasing and keep prices relatively low. But to keep output increasing, it needs to use expansionary monetary policy. So it's using open market operations. But to somehow curb inflation, it needs to use some sort of contractionary monetary policy. And these are contradictory, and yet in this case complementary, because the Fed is juggling two different problems. It's trying to keep inflation low when it's been high, and it's trying to keep output high when it's been low. This is tricky. Okay, I hope you've enjoyed the video. I hope you've learned something, and I look forward to seeing you again in a future video. Take care.